Alright guys, welcome back to another video. In this one, I did want to talk about how most people enter stock trades completely wrong and just by clicking buy and sell and hoping that they time the market correctly. I do not enter trades this way. I do not exit trades this way. I use options as a tactical execution layer to get paid to enter, to get paid to wait while I'm in the trade, and I get paid to exit all of my trades. I do this using cash secured puts and covered calls. A cash secured put allows me to place what I would like to call a paid limit order, and then I use a covered call to set my take profit and get paid to actually sell my shares. And yes, you heard that right. I get paid to sell my shares for a percent gain that I have pre-chosen. Once you understand how to do this, you stop chasing entries and start planning your trades even better. This will bump up your return by a huge amount, as I've found myself, and I'm very happy selling options this way and actually trading the markets this way now. So first of all, why do stock trades fail? Most stock trades fail not because the idea was wrong, but because the entry was very rushed. Market orders means there is zero control. Limit orders just shows patience, but there's no reward for having that level of patience. And waiting is just opportunity cost. The key thing here is a cash secured put will fix all three of those issues. So this is how I use a cash secured put as a paid limit order. As you can see right here, I actually own Robinhood at $108 average price. This was done completely intentionally. When I want to enter a stock trade, I don't buy the stock. I sell a cash secured put instead. Why do I do it like this? Because one, I want to own the stock. I already know the price I'm willing to buy it at, and in this case being $108. The caveat here is I have to buy 100 shares to do a cash secured put. So I'm agreeing to buy 100 shares at this price, and then the market pays me for making that agreement. So the only reason I'm getting paid to make this agreement is because I'm selling one contract, which equals 100 shares. So if we go over this, if $108 was my strike price, we have to multiply that by 100, which would give us $10,800 that I would be tying up in capital to make this trade. Now you can do this with a lot of smaller cap stocks that are for less money. SoFi is an example where that's trading at around $20. So you would only need around $2,000 to make a SoFi trade if you're doing a cash secured put example. So for this example, we are going to be using Hood because I am in this position currently, and I'm going to show you guys exactly my entry, my exit plan, and my whole thought process in between. So like I said, I want to own this. I already know the level I'm willing to buy it at, and I'm just agreeing to buy 100 shares. And for making that agreement, I'm getting paid up front for this. So there's two outcomes with this. The market was trading a lot higher when I made this agreement. I usually do this when I'm looking at the current price action. I'm studying it. I'm understanding where I'd want to buy this at, because as you can see, Hood is at a key support level. It is at a key support level right here. So I'm very happy owning shares at this level. And if we look to the left, which I would always recommend, always look to the left, you can see how many times we've actually been at this level. This is a very, very key support area for Hood, which I'm very happy to own it at. So first of all, price needs to be near some support or consolidation. The next thing is obviously I need to have this make sense in a way that I will buy the shares without having a bad premium price. Now, obviously, we're going to go over to an options chain to do this. And once we are there, we're going to actually see how much you can get paid for puts. So if we're looking at Hood's option chain, if you were selling one ending in 2 days, this isn't actually, let's use next week. If we sold a put on Hood at $102 right here, so 102 strike price, going over to the chart, that's all the way down here, right at this support level actually, you would actually get paid 2% on your position. All you have to do for that is take your strike price, which was $102 per share, times 100 shares, which is $10,200, and you're making 2% of that entire amount. And this equals $204. So you would be getting paid $204 just to agree to buy this stock at the 102 level. That sounds pretty great, doesn't it? Picking a strike price is very, very difficult, even though you're getting paid for it. If you set a strike price that is too close to price, you can be assigned in a really bad spot. If you're choosing a strike price that is in the middle of nowhere without any key support levels, the stock could completely dump. So you have to pay attention to where you're assigning yourself, because this is where the entry of your trade is going to be. Obviously, we are not going to be chasing premium here. You're making it make sense at a level that you're happy starting your trade with. Your strike quality is much more favored over the premium size. A good rule of thumb for me is targeting around 1% per that premium. And for owning the shares at this level, I sold a weekly put, meaning I had 1 week expiration because I did see we were pretty bearish on Hood. I did see the support level and I wanted to own at this level to earn some stock upside on this. So I sold with a 1.2% return, meaning I got paid around $120 just for agreeing to buy at this level. So there are two outcomes with this. Obviously, there is assignment and there is no assignment. Assignment means that you are assigned the shares at the level you chose. This would be your paid limit order. So basically, I agreed to buy the shares at this area because this is where I want the trade to start. So if price does trade below this and it expires below this, no matter where I choose, if we have this expiring at the 30th and we start trading below this area after the 30th, we are getting assigned the shares. It doesn't matter if we do this a month out, expiring February 20th. If the shares are trading below that level, this will assign us the shares. So you have to be pretty tactical with your assignments and how you're actually going to plan to start this trade, whether that's a weekly or a monthly put. Don't chase that premium is the moral of the story here. Obviously, the other outcome is that the price will trade above this level and it will not assign you the shares and you just keep that premium. So on the other hand of this trade, if Hood stayed above this level and never came below and didn't tap me in, I would have kept the premium. So I would have kept $120 completely free for just agreeing to buy a stock for 4 days. That's it. Other than that, I actually did get assigned on this. So this is what starts my trade. If assignment feels bad to you and you're scared of it, you are not trading this correctly and your strike is wrong. Now, one thing to remember with all of this is your time and expiration to actually frame your trade aggression. So if you're doing weeklies, like mostly that I do actually, you have faster time decay. So you have a higher percent return per the week, but you have less time exposure. So this does require more attention, understanding where the stock is, the levels you want to own it at, the levels you're willing to buy and start your trade at. But if you choose something over like monthly expirations, you have a wider buffer, there's less noise, there's lower stress. So monthlies are more for, longer and bigger strategic entries, where weekly options, it's almost intentionally getting assigned while earning a good premium to start your trade. So you can match the expiration length to how confident you are in a setup. So that's not really a fixed return target. So Hood, for example, is a company that I do want to own in the long term. We are trading 44% off the highs. I still think this stock is way, way undervalued currently. This is not financial advice. This is my opinion. This is a stock that I do want to own for the foreseeable future. So I do think we have a lot of room to make some gains on this. That being said, with Hood trading all along these lows right here, as you can see, we are very bearish on the stock from a market structure perspective. But once we formed this support zone, this is where I wanted to get involved in the trade. I use that cash secured put entry to enter myself at the 108 mark, and instead of just clicking a limit order or just clicking buy on this, I use that cash secured put to pay me to make the order right here. Now that I'm assigned, this is where the trade officially starts. I already have a buffer here. If I'm not assigned, there's no trade, I still got paid. But this is where we start framing our exit plan using a covered call. So we're going to use a covered call, which is just the inverse of a cash secured put. For a cash secured put, you're making an agreement to buy shares on the way down. A covered call is agreeing to sell shares on the way up. Now the key thing here is you can only sell a covered call when you own 100 shares. You can only do a cash secured put with 100 shares, so you can only do a covered call with 100 shares. If it's 99, you cannot do this. Now, this is where the payoff really happens. You've started your trade now. You understand that you are in this position, and now it is time to start getting paid for the stock gains. So this is currently live, as of January 26th when this video is being filmed. Hood is trading at 103, basically 104. So we are slightly in drawdown on this trade. Like I said, this is a stock that I am comfortable owning, and I will sell covered calls as long as needed until I get the gains that I want on this. But obviously, we do want a quicker execution for the fill on the TP on this. So I am looking to target the 122, 123 to 124 range as the level to have a take profit level at. So this is what I'm kind of looking for here. So what we can actually do here is check how much we would be paid. So what we're going to do is we're going to hop over to calls, and I'm going to check the options chain to see how much I'll actually get paid for this. So like I said, we're targeting around the 124 mark, which would be right here. This would yield us a 12% stock gain. That is pretty nice. I wouldn't mind that at all. But as you can see, the covered call premium on this is only 0.05%. Now, I'm not interested in a premium that low. Yes, we would earn a big stock percent gain being 12.73%. I would consider that a successful trade. But overall, I do want to see this premium a little bit higher. So what we can do is we can go 1 week, 2 weeks, 3 weeks, or even a month out. I find monthly calls do this the best, but I do have a certain percent goal that I like targeting myself here. So what I'm going to do is I'm going to look for a percent gain from the stock percent and the covered call percent to have a total covered call percent of a gain that I'm happy with. So if we hop over to a 3-week expiration, because obviously we are almost at the end of this current week, so this would be more of a 2.5 week expiration. As you can see, we do earn 1.23% in covered call gains along with a 12.73% stock gain. Now that is so much better for almost a total of 14%. So basically what I'm agreeing to do here is I'm saying, hey, you know what? If the stock does come up to this level and expires at $124 in 3 weeks, I will earn a 12.73% stock gain along with the 1.23% from the covered call. And remember, the 1.23% completely is just given to me up front. It is debited to my account completely, no matter what happens. If this expires in the money or out of the money, if Robinhood decides to stay in this range completely for the next 3 weeks, I still get that 1.23%, which is still over $120 just for agreeing to make this trade. Assuming we do come up in the next 3 weeks to this level, that would mean my shares are called away. The term we use here is getting called away on the shares. This would mean that the covered call has expired above my strike price or at my strike price. In 3 weeks time, if we're trading at 124 and above, my shares will get called away here. Not only, like I said, have I earned that 1.23% that has completely been debited to my account immediately, now I have a 12.73% stock gain for a total win of a 14% gain. Like I've said in many videos before, this is a very consistent way of trading and playing the markets. This is not bet your mom's house on call options. This is not how I trade. My portfolio is always maxed out doing this on a bunch of other positions. As you can see, I only have $2,000 to play with right now free in my portfolio because the rest of my portfolio is maxed out doing the work for me. I'm letting time and probability do all the heavy lifting. I'm just the guy that merely checks what percentage I want to make. Now, if I stretch this, a little bit higher, depending on where I'd actually want to sell this, you can see how this actually gets to be more beneficial for long-term holding the stock. Like if I went out over a month's period of time here and I chose to sell it at 130, we'd make almost 20%. So you do have to kind of mitigate how long you want to hold this for, how often you want to be selling these covered calls, and really picking a good target overall to exit your positions at with the percent gain that you'd like. Now, the perfect example of this would be on IREN, because a covered call essentially does cap your gains. I sold a covered call at 53 when my cost basis was a lot lower. So when IREN tapped me out at $53 a share, we actually ended up running like 15% that day, and I basically capped my gains at 6%. So it's very important that you actually are very aware of what the stock is doing, how volatile it is, where it could be going, because right now I would be up so much more from where I was. This would be an almost 32% gain. So you do have to be very aware of where you're capping your gains at, because you could have this set and the next day the stock absolutely rips another 15%, which is exactly what happened to me, and I capped my gains at around 5-6% from the stock gain itself. Obviously the covered call was fat, which was really good, but I could have squeezed out another 10% from stock gain along with a covered call. Going back over to Hood, this is my game plan personally. This is how I'm going to be playing this. The possible outcomes on this are prices, hits that call, the stock gain plus the premium, or, price doesn't. I still earn my premium, and then I sit back and I reassess, and then I say, okay, where would I be happy selling this at? Where do I cut this loss at? So there's a couple other things that actually go into this, but in a nutshell, the trade breakdown of this is using a cash secured put to actually enter the trade itself, and then using a covered call to cap the gains at the percentage that I want to earn. Every outcome with this is planned completely in advance. This is not a strategy where you're going to be gambling. This isn't a get rich quick strategy. This is a strategy that is a long-term investment type thing. It is very unk trading and it's not very popular, but I have the most consistent gains in the game. Personally, I'm very happy making 5-6% a month on my capital. There's no prop firms for this. This isn't something you can do, with fake money. That you have to have a real live account to do this on. Again, a couple things to remember here is this has to be done with 100 shares. Doesn't matter what the stock is. If you're doing Tesla, you're tying up around $40,000 with it trading at over $400 a share. So capital really does matter here. This strategy does force discipline and quality. You're trading like a portfolio manager. You're not trading like a gambler. If you want to be trading like like a gambler, you know, there's Forex, there's futures, you know, you can do that a lot and then a lot of other places, but this is not the place for this. So a couple of common execution errors on this is selling puts on junk stocks, you know, just chasing premiums overall, selling calls way too close to where your price is for entry, and treating cash gated puts as income instead of entries. Options don't fix bad decision making, they expose it. So I don't use options to be clever, I use them to be very intentional with my trades. Cash gated puts are how I enter stock trades, and covered calls are how I exit them. Once you see options this way, trading stops feeling very rushed and becomes a lot simpler. So if you trade stocks already, this is a skill that just upgrades everything. I can break down more real executions for you guys every single week if this is something you would like. We can go over stocks that you guys would like to see in the comment section. We broke down IBKR in a past video. If you guys have any other stock recommendations, send them through and we'll go over that. If you found value in this video, make sure to leave a like, subscribe, and we'll see you guys in the next one.